Guys, thank you for joining us for another episode of our Penny Educational Series. Today, we're going to talk about something fairly fun, the charitable giving and charitable remainder trusts. I do have the honorable Jake Bruner here backing me up. He's a state attorney in Colorado, does great work, and is just an overall great guy. Very, very knowledgeable. We're lucky to have him as a resource. And we'll go over a few different planning options to kind of help offset, both income and capital gains taxes, and set people up for, creating a legacy through charitable giving or charitable remainder trusts. So what I'll do, I'll have you kick on to the next slide there, Chris. And we are, kind of this whole thing is sponsored by the Penny A team. Basically, we built the Penny A team because life insurance opportunities rarely disappear because clients lack interest or because solutions are appropriate. More often, strong cases slow down or fall apart due to the operational demands required to move them from conversation to placement. Gathering client information, completing applications, managing requirements, coordinating underwriting, and maintaining follow-up can quickly become overwhelming. Even highly successful producers often find themselves pulled away from revenue-generating activities just to keep cases moving forward. When follow-up becomes inconsistent, timelines stretch too long, momentum can fade, and time can kill deals. Clients become distracted, decisions are delayed, and opportunities that should have resulted in placed business are often lost due to process rather than strategy. The solution? Our Penny A team back office support. The Penny A team is a dedicated group of specialists designed to function as an operational extension of your practice. Once you identify an opportunity and make a warm introduction, the A team helps manage the implementation process from start to finish. This includes guiding the client through the application process, coordinating underwriting, and supporting the path to policy approval and delivery. So, how does the A team support your business? We will assist with and help lead client conversations when needed to ensure clarity and professionalism, manage application completion and documentation requirements to reduce administrative burden, coordinate with carriers and underwriting teams through an experienced case management group with over 45 plus years of combined experience. We'll track requirements, monitor progress, and maintain consistent communication through the underwriting process. We'll proactively follow up and keep the cases moving toward approval or placement. And what this means for you as agents is you'll spend less time managing paperwork, requirements, and carrier communication, be able to stay focused on the highest value activities, building relationships, advising clients, and identifying new opportunities, as well as you'll maintain full ownership of the client relationship while the operational team works behind the scenes on your behalf. It will improve case momentum, placement rates, and overall client experience, and help you scale production without hiring additional internal staff or increasing operational complexity. The goal, simply, help agents place more business, create a smoother experience for clients, and enable advisors to scale their practices efficiently and sustainably. Have me move on to the next slide. And here's a testimonial from one of our end zone guys that we work with. I'm actually currently working a couple cases with G. Great guy, wonderful resource to work with, very knowledgeable as well. Have you click on to the next one. And then also, Cyrus runs a podcast internally for EndZone that reaches over 1,400 agents. Absolutely great guy. He did have us on as a guest, and we have worked some cases with him that had some very, very good outcomes and great results. And from there, we'll move on to the next slide. So, without any further ado, I'd like to introduce Jake and kind of have him talk a little bit on the slides, and then I'll kind of jump in and help as needed. But he is extremely knowledgeable, and he's an attorney out of Colorado that specializes in estate and legacy work. So without any further ado, this is Jake Bruner.
Thank you, Charles, for that very kind introduction. Hi, everybody. Happy to be back. Like Charles said, I do wealth and estate planning work out here in Colorado. I run a law firm called Future Proof Law, LLC. We focus on millennial planning, digital asset holder planning, and also high net worth families, which obviously is a big portion of the work that you guys do as well. I'm licensed in Colorado, PA, Florida, and Ohio. So if I can ever be of service, let me know. let's talk about some charitable planning topics today. So, just at a high level, charitable planning is a very central feature of the American economy. It goes back a very long time, and the tax code has been written in a way that reflects that. Right? It was put out there and created to really reduce the burden on governmental agencies while also providing significant social benefits. When I talk about charitable planning, when Charles talks about planning in the estate planning context, I think it's important to distinguish just at the outset, like what entities are we talking about here, right? People throw the terms nonprofits, tax exempt entities, charitable organizations, they throw them around pretty loosely and interchangeably. Primarily in the estate planning context, what we're talking about today are charitable organizations where you would get some sort of tax advantage deduction for your contributions. So the most common one that everyone thinks about is some type of 501c3 entity, right? The advantages that those organizations have when you provide charitable contributions are threefold in the estate planning context. Income tax charitable deductions, usually for people who itemize, and up to a certain limit depending on the type of entity they're contributing to, a gift tax charitable deduction, and then an estate tax charitable deduction. So those are the three things that we primarily focus on in the estate planning context. Turning to the slide in front of you, there are a number of different vehicles that we use. You can go back one, Chris. There are a number of different vehicles that we use to make these contributions, each of which have their own kind of pros and cons, right? So, even before you get to the ones on this slide, some people, higher net worth clients, they set up things like private foundations, that allows family to make large scale grants. And then at the smaller level, maybe if you have less than $5 million net worth, you're going to look into something like a donor advised fund. What we're going to talk about today are kind of sub pieces of those things, primarily focused on split interest gifts. So someone gives some type of gift to charity and then a remainder interest to a non-charitable beneficiary, or vice versa. So, Chris, you can start with the first one. The first one we're going to talk about here is charitable remainder trusts. You'll sometimes hear these referred to as CRTs, and as Charles and I will talk about here, you can go one more, Chris. There are a number of different variations on these trusts, right? So the way that they work primarily is there is an income stream that is set up to go to a non-charitable beneficiary in a fixed amount or percentage, usually about 5% of the trust assets for a term of years or for life. And that income payment is paid annually to the non-charitable beneficiary upfront. And then the remainder interest will pass to the charity and no other party, right? It's important that it only is passing to the charity. And one caveat when we set these things up is that the value of that remainder interest that passes ultimately has to meet a specific threshold. It has to be at least 10% of the fair market value of the trust assets at the time they are placed into trust. So that's just kind of the mechanics of how it works in terms of like legal requirements. There are a number of different flavors of these trusts too. The most common at Penny might be something like a charitable remainder annuity trust. This is a trust that essentially pays an income interest to the non-charitable beneficiary upfront in a fixed amount or a fixed percentage, right? So again, normally about 5%, sometimes a little more, sometimes a little less. As compared to a charitable remainder unit trust, a CRUT, which that number can be adjusted annually depending on how the assets in the trust go up and down, right? So it provides a little bit more flexibility to the trustee and allows you to do a little bit more careful tax planning if your trust has been set up that particular way. Charles, do you want to talk a little bit about those subtypes there?
Yeah, so really, in layman's terms, there is kind of a four-step flow on creating it, and then I'll give you a super simple example of how one might work, and then all of these CRTs are pretty much going to be defined under IRC code 664. So how it works, you're going to put an asset into a trust. Maybe you bought some Exxon stock 40 years ago, and it's appreciated tons. Or another asset. Could be real estate. Could it be a business interest even? You put it into the trust. The trust can sell that asset with no immediate capital gains tax inside the trust. You can pull income during your life from that trust paid to you or somebody you choose, could be an heir, and then it could be either for life or a set number of years. And then the remainder of that would go over to charity as the person who is drawing out of it, passes. So a super simple example: let's say you got $1 million in stocks. You put it into a CRT. The trust sells it with no upfront tax hit. You get the income, we'll say 50K a year, and you get a charitable tax deduction today. And then when you pass, the remaining balance would go to the earmarked charity. So it's kind of your earmarking some assets to go to a charity. You're getting the tax deductions today. The only real caveats of it that we look at is they are irrevocable. Once you set one of these things up, they're permanent. You can't walk it back. You would do this in accordance with a plan with a financial advisor, a very competent estate and tax attorney like Jake, and they'll help you set up the entities, and then you can create an income stream that you can use for a period of years, earmark it for charity, and then the remainder after you pass would go to the charity giving you those tax deductions in your state. Um,
Yeah, so as Charles said, I mean, they're great for mitigating capital gains taxes on low basis assets, no matter what that asset is. And really, it also helps your client fulfill a charitable intent, right? Even though that interest may pass to charity after they're gone, they will have some peace of mind knowing that they're fulfilling whatever their charitable intent is. And also, I mean, we'll talk about this in a couple slides here, but as Charles said, there's an income stream that gets spun out of these CRTs, right? So it's not like you are making some charitable contribution and then you're limited in what you can do. You're limited in what you can do with the asset, but you have income coming back out, and maybe you want to do something like fund an ILIT, right, that provides liquidity for your heirs at death. So these are great planning tools, great for charitable inclined clients, and great for people who have high net worth and are looking to take significant low basis assets out of their estate. And Chris, we'll go on to the next slide and we'll talk a little bit about a different flavor. So a charitable, actually, before I even get to this, so one thing that we didn't put in here, another thing you can do aside from creating a charitable remainder trust is for clients who maybe have a house or a vacation home or even a farm property that they want to live in during their life. You can also set up something called a 170F remainder interest, named after the code provision. Unlike putting something in a trust in the CRT, this actually allows you to leave a remainder interest in property. So if you have a client who has a special attachment to that property, wants to live in it during their life, unlike what they would be able to do in a CRT, that's an option too. It's just kind of a different flavor of a charitable remainder interest. On the other hand, we can reverse the order of operations here, right? There's also things called charitable lead trusts, and as the name implies, the structure of this one is you're going to donate an asset, or you're going to gift an asset to the charity first, and then the remainder interest will pass to your non-charitable beneficiary. The mechanics, the legal mechanics of it are fairly similar to a CRT. The caveat being that there's not necessarily the interest limitation on the value that needs to pass to the beneficiary. There needs to be a 10% interest that passes to the charity in a CRT. That limitation does not exist with the CLT. So a little bit more flexibility in that regard. And then similar to the CRT, there's also flavors of this too, right? You could spit out an income interest to charity in a fixed percentage, like an annuity. It could also spit it out in a unit trust format, where it's sort of adjusting based on the percentage of assets in the trust. Similar to the CRT, you also get an upfront income tax deduction for certain types of charitable lead trusts here. The primary benefit to using a CLT, maybe as opposed to a CRT, is that it actually freezes, from an income tax perspective, the value of what is going to pass to the heirs in the future, right? So it's valuing that interest today, which is great if you have low basis assets like, concentrated equities. Maybe you got some Bitcoin that you bought 10 years ago and has appreciated, 10,000% or something like that. So these are another type of split interest trusts that are great planning tools for your high net worth clients. You can go to the next one, Chris. Another flavor of charitable giving. So this one's a little bit different, right? Penny, and maybe Charles can talk a little bit more about annuities within Penny. Um, but for clients who are both charitably inclined, looking for some tax advantages, and also are looking for sort of the income drawback or the income kickoffs of an annuity plan, you could also look into setting up something called a charitable gift annuity. These are CGAs for short. And the way it works is these are basically private annuities that come from the charity and provide certain tax advantages, right? So your donor is going to transfer maybe cash or even appreciated stock to a charity. There's usually a minimum threshold there. Uh, uh, someone can't donate $10 and expect to get an annuity back, right? There's usually going to be a significant 5-figure minimum for them to get this. The charity itself, with the help of legal counsel, can issue a fixed annuity contract back to your donor. It's going to spin off about 5 to 10, 5, 9, 5 to, or 9 to 10% a year for the donor's life. And then your donor is going to receive a partial income tax deduction for that contribution, and some tax-free return on capital for that contribution. So again, these are sort of just another flavor, another way for your clients to make and fulfill their charitable inclinations and also get some tax benefits, right? So they're usually a little bit cheaper than private annuities. And really the primary benefit, like where I've used them with my clients, are clients who actually want to see the fruits of their charitable gifts during life, right? If you have a charitable remainder interest, you're not really going to see how that charity gets to use that gift because you're going to be gone. With these, you get to both enjoy that gift up front, you get to enjoy the income that's spun off of it, and you also get some special tax advantages. By some accounting rules, the capital gain that you would otherwise recognize from the sale of these assets through a CGA can actually be spread out over the donor's life expectancy, resulting in some more favorable tax consequences. And if you have clients that have like S corps, which can be very tricky from a trust perspective if you've ever dealt with that. These are great tools to play in with S corp stock as well. There's very specific limitations on how to contribute S corp stock to trust. So these are certainly something we like to use. You can go to the next one, Chris. And then eyelids. So if any of you have attended previous webinars with me and Penny, we had another one on irrevocable life insurance trusts. So these aren't per se charitable giving vehicles, right? I mean, they can be used for a variety of reasons, primarily to create liquidity, either for heirs before death or after death, I'm sorry, or for pre-business IPO situations. These aren't per se charitable giving vehicles, but as I mentioned earlier, they can often be combined with CRTs, where we use the income that's spun off to fund these accounts to create that liquidity at death, right? So for those of you who may have not had the benefit of attending the prior webinar on eyelids, just a brief overview of the structure. We create an irrevocable trust. Again, as Charles said, that's not reversible. It's irrevocable once you put your assets into it. What's done is done. The trust would then apply for and own the life insurance policy. Importantly, it cannot be owned by the grantor, or it's going to come back into their estate at death. And then the grantor will fund that insurance, will basically pay the premiums through annual gifting. The one caveat to that from a legal perspective is that we need to make sure we're complying with crummy notices, which essentially we're going to issue a notice to the beneficiaries telling them they have a technical right to withdraw the amount that we're contributing each year or each month. There's a time period that crummy allows for them to withdraw those funds, and this just allows it to be exempt for gift tax purposes, and also qualify for the annual gift tax exclusion. And then when we do that, ultimately, it allows the trust to collect these benefits at death. So again, an eyelid is a great planning tool. It allows for us to take a significant portion of appreciated assets out of the grantor's estate at death, It also provides creditor and asset protection to the heirs. It provides liquidity to heirs. And like I said, it provides annual gift exclusion compliance as long as we're issuing those crummy notices. So
It's really two
again,
simple ways to use the eyelet to just in the course of our conversation today. One of them is it acts as a force multiplier for a certain amount of dollars to be able to meet the threshold to pay off of, let's say, you get that 40% estate tax. You can plan the insurance to pass the heirs over to the heirs, but then the proceeds from the policy would go to the tax bill, or in the concept or kind of the construct of what we're talking about, you can use it as a force multiplier for charitable giving. Let's say you've got a Lutheran church or some church you've been involved with, or ASPCA or whatever charity you've been on the board, you've done stuff with them forever. You want to leave a legacy to them. You can use it as a force multiplier, but maybe paying 200,000 in insurance premiums and leave up to 2 million or 2.5 million, which would be more than you'd normally be able to gift with the amount of assets that you had. So there's two ways you can kind of use that in that context, and there's a million different variations that kind of lie within that. But those are two very simple layman's explanations of how they can be used in conjunction with some charitable giving as well. Sorry about that.
no, that's super helpful. That's super helpful. Again, great complementary planning tool for your charitably inclined clients is to be able to use that income that funds is spun off from the charitable trust to fund these ILETs. You can go to the next one, Chris. So it looks like there was maybe a question in the chat about what types of clients are good fits for these types of legal structures and vehicles. So it really depends, right? So it depends on the entity, it depends on the client. But in general, if you have clients with, significant appreciated assets, low basis stock, real estate, specifically closely held family businesses, that's always a common one. Charitable remainder trusts and perhaps charitable gift annuities are a great way to unlock value without them taking that capital gains hit. It also, again, allows them to fulfill a charitable inclination if they are so inclined. Multi-generational families, usually this is kind of a generalization, but I would say, estates or would-be estates with over $5 million of assets, typically that's kind of the threshold that we look at, not from an estate tax threshold standpoint, but just from does it make sense to use these types of charitable structures to do some tax planning? That's usually a good threshold where, we're starting to get into these conversations about whether or not we should be using a CLT, a CRT, an ILET. Philanthropically motivated donors, right? Really anybody with charitable intent, we can set these up for everyone. But I think, if you have clients who are under seven figures, maybe simpler structures make sense, right? Like setting up something like a donor advised fund, which for those of you who don't know is basically it almost functions like a bank account, where you contribute assets and those assets can be distributed over time to charities of your choosing. But ultimately, that account is kind of managed or held within some other type of large financial institution, right? So that makes sense for smaller clients. For larger clients, they may want and need some of these more advanced structures. And then certainly business owners who are expecting a sale or IPO or something like that, funding these types of structures before their liquidity event can allow them to really convert something that would otherwise be illiquid into a diversified income and a charitable legacy. So we see a lot of pre-sale business owners coming in looking to set these structures up as well. Charles, anything to add?
Yeah, really, when you're talking to people, when they're talking about maybe they're selling a business or maybe they run a family office, if they are looking at kind of they're in the highest tax bracket and they're exposed with their assets to a large amount of capital gains, that is a trigger word kind of for you. If they're over that threshold and they are going to, see anywhere from, let's say they're very, very wealthy and they have, some separate business interests, especially like with the family office style, we see people that they might have a $20 million appreciation on a business over 20, 30 years. They're getting ready to sell the business. and they could be exposed to anywhere from 1 million to 7 million in capital gains taxes. If that is something that you're hearing, this is definitely something that you'd want to talk to them about. Also, those that are trying to create a legacy that are more apt or to push their legacy money over to a certain cause that they care about, that they're pretty they have some influence in that realm. This is a great opportunity for them to use it as a kind of a force multiplier and mitigate their taxes at the same time. So really the trigger words are on this is, hey, I'm exposed to a whole lot of capital gains taxes due to my business activities or family business activities, or I'm in the highest tax bracket and I'm wanting to leave a legacy. Those are really two major triggers that would cause you to want to run to guys like Jake and I to talk about options of either donor advised funds, CRTs, or creating an islet to kind of buffer that out to some degree.
Cool. And I know we had a few more questions that came in. So the first question is the income taxed as ordinary income from the CRT?
To the beneficiary, it's under actually it's taxed under a four-tiered structure. The ordinary income distributions, they're first characterized as ordinary income to the extent the trust has current or accumulated ordinary income. It is then at the second tier, once that ordinary income has been exhausted, the distributions are treated as capital gains, first short term, then long term. Then there's a third tier where other tax exempt income like municipal bond interest is going to be treated in that third tier after the capital gains tier. And then the fourth tier, there's a return of corpus distributions of the original principal. So eventually you get to it where it's tax free. But yeah, it works under a tiered structure depending on the client's situation.
And then we have one last question that came in. How do top producers consistently uncover CRT opportunities within their existing client base?
Absolutely. You're having organic conversations with your clients about what kind of legacy that they want to leave. And then also being able to identify, what kind of clients. And like we said, those are going to be those that are exposed to high rates of either estate tax, large amounts of capital gains taxes, or let's say they are at the very highest income thresholds and also have a considerable amount of assets to dispose of at their passing, going to their estate. So those are really kind of the ways you start the organic conversations. And I would ask them, hey, do you have a plan for, are you trying to leave a legacy, or, what makes sense for, do you do any charitable gifting? That's a good way to start the conversation. And you'll start that after you kind of realize or find out that they're going to be in the highest income brackets, they have considerable assets, and they would be exposed to a large amount of capital gains tax.
Yeah, I would add that, I mean, a lot of the folks who fall into those categories too, they're already probably thinking a little bit to some extent about charitable giving. If you look at some of the recent trends and statistics on charitable giving, it's actually really interesting. What we're finding in the estate planning context is that while there are less people who are contributing to charity these days compared to maybe 10 or 20 years ago, the people who are contributing, the high net worth clients that you guys have, are contributing a lot more than they otherwise would and otherwise did previously. So actually charitable giving has gone up significantly really in the past decade. So I suspect that your clients are probably thinking about some of this stuff, but certainly, as Charles said, kind of identifying if they fall into these categories that we just talked about, pre-business, pre-sale business owners, folks with highly appreciated low basis assets, certainly a topic to broach with them.
Yeah, one thing we've seen in the last 10 years is the family office construct has gotten a lot bigger and more popular, and we're starting to see them bring out menu items as far as tax mitigation. So when they're talking to clients like this, CRTs have kind of become even more popular to do under that IRC code 633. It's a great code that allows people to kind of shift money to where it needs to go and reap the tax benefits. And it can be very, very hard sometimes, especially with entities and considerable amounts of assets. If you've had many years of appreciation to help, offset, larger amounts of capital gains taxes. This is one of the few strategies that's probably the least complicated that you can help to offset some capital gains taxes.
Thanks so much, Jake and Charles. Any closing thoughts?
I appreciate everybody showing up, and yeah, like I said, charitable giving is a fun topic, and it's fun to plan around. So if I can be of any help to you guys, your clients, like I said, Colorado, Florida, Ohio, and PA is where I do business, but also happy to connect anybody with attorneys in other states as well. And I know Penny has connections as well too.
Jake has been a great resource for us. We love working with him, and he knows this, this area of expertise, quite, in quite detail. So we'd be happy if you have any clients that are looking to do stuff like this. We're happy to, jump on an initial consult and, steer them in the right direction and kind of show them the benefits of this outlay.